Hi, everyone, and welcome to another virtual coffee with Software Equity Group. I'm Austin Hammer. I'm a senior associate here on the deal execution team. And I'm excited today to be welcoming my guest, Jonathan Christie. He is a manager in the transaction services department at Grant Thornton, specializing in M&A transactions and buy-side due diligence, as well as sell-side. I consider myself very fortunate to have worked with Jonathan and his team. And I'm really appreciative of his time and excited to have him on. So Jonathan, thanks so much for coming on today and discussing cost of goods sold a little bit.
Yeah, no, Austin, thanks so much for having me. It's great to obviously we've worked together a number of times, so it's great to connect virtually especially over a cup of coffee here.
Yeah,
for me a little later in the day, but tea.
Yes, sir. Cheers.
But yeah, no, excited to dive into this very interesting and hot topic of cost of goods sold.
Yes, absolutely. It's riveting stuff as always. So yeah. I think what would be great as a starting point here is to get a little bit of background on yourself and also how it is you came to be at Grant Thornton, and then what it is you guys do with transaction services and in your diligence processes. Just to give a little bit of a background here.
Yeah, absolutely. So I went to school at the University of Georgia. From there, I worked in audit at KPMG for about three and a half years. And after that, had a solid foundation of just understanding, financials and, spending a lot of time with, mostly larger companies. But got into transaction services in early 2018. And when I came over to Grant Thornton, and have been at GT since then, so approaching almost 3 years. And you hit on the nose, right? So I'm focused on we're in financial due diligence, and with that, at the core, it's mostly around quality of earnings, right? We do some other working capital analysis and debt-like, and there's other levels of transaction support, but quality of earnings is our main focus, and with that, it's always very exciting just working with entrepreneurs, on the sell side, and private equity and other strategic buyers on the buy side. But at its core, we're just understanding, trying to understand the quality of companies' financial statements, and with that, piecing together the historical trends, making sure the numbers are properly telling the story, and if not, just understanding if there's any accounting related adjustments, right, that are not presenting the business on a go forward basis with what potential investors see the business. So
I think exactly the part that we've really, I think, benefited a lot of is like you said, it's in the name, but quality, right? In every transaction there will be a quality of earnings done, whether it's on the buyer's side in diligence or in diligence or pre-diligence on the seller side. And the way that we always describe it to clients is you may drive the car, you may have a pretty good understanding of how it looks on the outside and how well you think the engine works. But it's a whole different ballgame when you bring in a mechanic to analyze every piece in the engine. And even if the result is confirming what you already know, having that thorough run through is critical, and something that in an M&A transaction is always going to be something that is mandatory. And so having a high quality firm like a Grant Thornton come in and do that work is something that benefits these processes immensely. So
appreciate that, awesome. But again, the goal is to try to eliminate, and as in the process is just trying to eliminate surprises, right? So
absolutely,
we're just trying to get to the
de-risking and eliminating surprises is the name of the game, as you're well aware. So awesome. Well, before we get into the topic here, I did want to note Jonathan is a Georgia boy, born and raised, and as a result of that, is a Georgia sports fan. And the history says that you guys don't always perform well under pressure. I don't need to give you the rundown of that, but being that I myself am from Los Angeles and am a Dodgers fan, I just figured I would hang up my Dodgers flag in the background here for you to see. so that, here we go, so that you've got a little view of that to perform under pressure in the background, just
That's
as a
right.
reminder as we
I
chat.
shouldn't be wearing blue here. This, I wasn't prepared.
I know I caught you let-handed. I coaxed you into it. So we'll see how you do. Maybe if you nail a couple questions here, I'll take it down and let you live on. So just to preface this, Jonathan, about 3 years ago, Software Equity Group published a blog on cost of goods sold. Mm-hmm. It's something that we had kind of noticed that we had a pretty good understanding of, and the way that the market and the buyer universe viewed COGS was, pretty different from how a lot of our clients were analyzing it. And they just didn't have the information of how buyers would look at it. And so we published this blog, and ultimately ended up becoming one of our most popular and well-performing blogs over the last few years. And so, our thought was, wanting to bring in an expert's perspective to dig into it a little bit deeper. And so what I'd like to do is share my screen quickly and give a quick example. So this is a slide we put together called, the compounding effects of gross profit margin. And what we've done in this analysis is really basic, but just compare two companies who are, exactly the same. They're both growing at 10%, annually on a revenue basis, 5% on an expenses basis. So, achieving some economies of scale as they grow. Both companies, A and B, starting at 10 million of revenue per year. But one key difference, company A has a very rudimentary understanding of its cost of goods sold. It's sort of done the bare minimum in assessing what costs are, servicing revenue and the basic understanding of what goes into cost of goods sold businesses. So it's an accurate look, but not a super in-depth or understanding, look from their perspective of COGS. Meanwhile, company B has developed a very sophisticated and educated view into their cost of goods sold calculation. And as a result of that, they have a better understanding of how to efficiently allocate labor and time, how best to manage their hosting and third-party annual fees expenses, and have driven some operational efficiency, and as a result have been able to increase their gross profit margin to 80%. And so the point of this being, companies that are otherwise equal with small differences in gross profit margin, you can see the very real effects here on the right side on profitability. And over a 5-year period, by that fifth year, almost 2.5 times as profitable. And so not just from the perspective of being able to present the business in the best light, but also to understand how to improve profitability operationally has a very material impact that comes from gross profit margin understanding. And further than that, when you think about undergoing an M&A transaction, the ability to get the benefits of more profitability from a multiple standpoint, just goes to show how important it is to understand gross profit margin and how it compounds year over year with more growth and profitability.
No, absolutely, man. Austin, I think this is a great depiction of what, having that information, and as accountants, we love to have a detailed information, but what operators and, business owners can do, right? Like just having information to understand hosting costs and, labor costs that are required to service the revenue, how you can make operational improvements to identify value, right? You see in this case, company B was able to, make those changes and kind of right size certain costs, which had $1.5 million or so of additional, net any bottom line income through year 5. So
exactly. And the reason we wanted to bring in Jonathan today for this discussion is if you're company A and don't have as developed or sophisticated as a view of your cost of goods sold, we want to help, see how you guys can get there a little bit better. So I think, with that in mind, Jonathan, what would be really helpful is just sort of starting at the highest level. Talk a little bit, about what cost of goods sold and gross profit margin are and why it's important to understand them, and businesses to track them. And furthermore, why specifically for software and SaaS companies, it's such a critical piece.
Sure. So, cost of goods sold in simplest form are your direct costs required to, to service the revenue, right? So if you think from a manufacturing company who produces a tangible product, right? This is, these would be the raw labor or raw material costs and labor that go into producing each product, right? And obviously it's something that a company has to consistently do over time, right? It's not one time in nature. It's going to be something that's with the business to, to create revenue, right? You need those costs to create revenue to have a product. And obviously your gross profit is just revenue, less those costs. And, that metric is incredibly important from a potential investor's view, just to understand, hey, what's that first pass at profitability? And it's especially important, when you think from an earlier stage company who might not, they might still be maturing and not, fully scaled, right? So bottom line might not be profitable, but just understanding, hey, what's the potential here with this company in terms of profitability? So that's that first view of profitability. And you think about a SaaS business, it's very exciting, right? Because you're in you have an intangible product, right? So you don't have necessarily that raw material cost for each product or widget you're selling, right? You have development costs, whatever, to create the product, but then from there, it's just servicing, right? So, it's obviously very exciting in the SaaS world because they're so profitable, right? So, it's important, but that said, from an investor's perspective, it's important to understand what, from what pricing power does the company hold, or, are there any costs, either, fixed or variable, that are recurring and that are required to service that revenue, right? Because if you think a company already has the customers, they already have the product, but going forward, what does that look like?
Yep. Yeah, and I think that's really some of the value that we've picked up in working with the Grant Thornton team is that kind of tagline, the cost of servicing revenue. And the way you think about it is you've got a finished product and the software is ready to go and built out. You've got a signed customer, right? What costs are absolutely necessary in order to begin generating revenue from that customer and bringing the product and the customer together, and not just getting that marriage in place, but having it continue on a go-forward basis. And as you mentioned, for software businesses, this is a very critical component because the nature of SaaS is to be highly sticky and high margin businesses. And so to be a software and technology business that is coming in with a software product, but showing a lower than anticipated gross margin, would potentially run into some issues in an M&A transaction. And so understanding how best to understand that gross margin and calculate it is critically important. So diving a little bit more into the details, Jonathan.
Sure.
For SaaS companies, typically, what should be included in the cost of goods sold calculation? Kind of delineated and broken out between labor and non-labor expenses.
Yeah, absolutely. So this is where GAAP or accounting rules isn't clear, so there is a little discretion here in practice. But generally, from a labor perspective, right, it's any employee that is needed to either to get the customer operation with the product, right? So as you've said, you've got the product, it's already developed, and you have customers. It's like, okay, how can the customer use that product? So you think, SaaS is the kind of one-time implementation services. From there, you have training, onboarding, and then go forward customer support, and then any add-on customization to the software or upgrades, if you will, labor required to fulfill, to provide those services. And I think the challenge here for most, especially or smaller and middle market businesses, is they might have someone who wears two hats, right? So they're they might do some development work, but also in terms of developing product, but also they're on the implementation team or customer support. So obviously, we're taking a step back and thinking, okay, should development costs be part of recurring or cost to service revenue? And those are generally kind of fall into R&D, be part of OpEx. So that's where it's important just to have an understanding of, first off, which customers even have a portion of their time spent to servicing revenue. That's it from a labor perspective. From a non-labor perspective, and this is where it's fun, right? And software, there aren't a ton of you don't have those raw material tangible costs. But you do have hosting costs, third-party license fees to operate or to support the technology's functionality. Again, yeah, there aren't. That's the beauty of it. There aren't a ton of costs, but again, it's thinking of those costs too that are instrumental in allowing the product to operate.
Absolutely. Yeah. Yeah. And that's exactly it. And on the labor side too, and we'll talk about this a little bit later, but I think another point I just want to drive home is it's the classic, customer support, implementation and training, professional services. So any ongoing services provided to not just get the customer started, but to continue their success of using the product, whether it's ongoing projects or an ongoing recurring service that's provided. And that's something that frequently we see clients, not necessarily always taking into account. And then of course on the technology side, any third-party annual fees for software used to support the client or hosting fees as well. So that's a great summation. In your experience, when you go in and dig under the hood of companies, what are some of the most common mistakes you see with companies and how they're calculating COGS, whether it be including something in cost of goods sold that should be OpEx, or vice versa, something that they aren't, not including in COGS that they probably should be?
Yeah, and Austin, mistakes. I don't want to use that in a negative sense, right? It's just at certain stages, right? A company might not, it's a 10-man or 10-person operation, and they don't have 2 or 3 accounting heads to try to focus and allocate costs, right? Or they're working with a QuickBooks or some ERP system that doesn't have a ton of flexibility and functionality. But generally what we'll see, right, is that all labor costs will flow down into operating expense, right? Which obviously, if you think about some of the functions we were talking about earlier in customer support, services, training, those folks, their salaries would fall into operating expenses. So I think that's one area where it's just all the labor goes there. And I'd say most operators are good, or companies are good about having some of the direct costs, like hosting costs, actually recorded up in cost of goods sold or cost of revenue, because those are, again, it's pretty easy to identify those and track them separately. But that's I'd say to that point, in terms of the non-labor, what we do see that makes it challenging is a company on their financials might just present technology costs just in one bucket, right? It's not, it's not at the detailed level to identify, okay, here's some other software costs, right? That maybe it's Salesforce or something that's a CRM, which you wouldn't want in cost of revenue, but it's part of this technology bucket, and all of it's flowing into cost of revenue, which is understating either gross profit and kind of short, under positioning what the company, from a gross profit perspective could achieve. That makes a lot of sense, and thank you for that answer, Jonathan. And I think a great point that you highlighted is it's not per se mistakes, but more of has to do with where the company is at. And kind of flowing into the next question here, specifically dialing in on the labor cost of goods sold. A lot of companies are less mature or in growth phases and don't have as many employees, and so they're focused on developing product, on building a go-to-market strategy. The last thing a lot of operators are thinking of as they're working down the laundry list of all of the challenges they have to meet is how to properly calculate their labor cost of goods sold. So you raised a good point there. It's more to do with resource allocation. So going forward, what are some ways that these companies can get in the habit of determining labor cost of goods sold and allocating employee times for those companies where employees are wearing multiple hats? Say developers are spent half the time on the product roadmap, but the other half the time on bug fixes and customer support. From your experience, what is the most effective way for these companies to correctly allocate their labor cost of goods sold? Yeah, no, I mean, I think, Austin, it's first just on, getting the number of employees who are in that, direct category, right? So maybe they do support customer onboarding and implementation, but they do wear a developer's hat, as well. So I think it's first just having that list of employees who split time between, those functions, right? And getting the understanding. And again, if we're talking about a smaller company, fortunately, there aren't a ton of employees to go through, but it's just having that list or getting, a census, with all your employees, understanding first just by department, just, bucketing, those 3 or 4 components in terms of onboarding, recurring customer support, development, right? Those kind of core functions. And then just understanding, at a high level, thinking through what percentage of time they're spending on those functions. So that, that's something that's helpful. And again, it's tough, but I think at least having, because obviously judgment can be made in terms of splitting 50-50 time between implementation and say development, right? But what's helpful for potential investors, at least understanding, how many employees at this stage of the company are needed to support recurring revenue. Because as the business scales, obviously you're going to have dedicated departments who are for each of those functions. But it's just to give an idea, because it's tough. You can't chop somebody in half and say, all right, you're going to be up here at COGS and you're going to be in OpEx. But at least just gives an idea of the potential investor, someone reviewing the margins of what a scaled business would look like. Right.
And that's a fantastic point too. Is it's not just from an operational perspective beneficial to understand, but as an investor, a buyer comes in with an idea to scale the company, they're going to be more interested, you're saying, in understanding just what the current balance is between those different departments. So as they scale from 20 to 30 to 50 to 100 employees, while they may not be bringing in people with the idea of splitting time, they will have a pretty good idea of what that balance looks like as they're understanding in their diligence process as well.
Yep, absolutely.
So one last question here, Jonathan. If I'm company A in our example, and I don't have a very sophisticated look into cost of goods sold, and I come to you today and I say, Jonathan, 3 years from now, I want to undergo an M&A transaction. What can I do between now and then that will benefit me in understanding gross margins better and having a more sophisticated view into that, so that when I undergo a transaction, it's de-risked, it's smoother, it's easier for me to understand and talk to the operational efficiencies of the margins. What would you recommend, a few key things that an entrepreneur can do today?
Yeah, I mean, I think first it's just understanding what existing capabilities your accounting system does have at the moment. What we see a lot of times is that operators or companies they're not aware of what their accounting system could do, right? So there might have been functionality to split certain departments by payroll, and oftentimes they're using a third-party payroll provider, but that they could bucket those employees between, say, sales and marketing or G&A, customer support, things like that. So at least at a high level, having some labor costs route to cost of goods sold would be helpful. So one, just understanding the capabilities to see if there's anything that can be done. And then two, if you're not gonna, or if it'd be too tough to, do that detailed analysis, but just understanding at a high level which employees are essential in, servicing that revenue, right? So just having that core understanding is really helpful, from that way, whenever you guys come in the process, you're able to help them, identify some of those, where there's any pain points or potential opportunities, right? So that's it from a labor perspective. And then, non-labor in terms of some of those hosting, third party, it just, again, comes back to granularity and having really, captioning, not just bucketing. Again, we'll see it as an accountant or in the diligence process, having like a other category or very, bulky category with not detail. So to the extent, companies can start, really detailing out those software, particularly software like hosting, like by vendor, and understanding what each of those vendors are doing, payment, the timing of payment. A lot of those you're paying for annual subscriptions. So to the extent you're aware that that's an annual subscription and can, pro forma or estimate what the monthly expense should look like in the P&L, that's super helpful. And again, but at a minimum, just having the granularity by vendor and understanding what each of your, these software costs or third-party software costs, how you're, what service they're providing.
Yeah, no, that's a great point. And I think we typically, are always preaching the labor side, but the non-labor side, you make some really good points that it's just as important to go in and understand granularly as you scale a business and, want to point to sustainable growth in that business. Understanding how those costs have trended is critically important as well. So, well, Jonathan, I think it's safe to say you've bucked the Atlanta sports trends of performing under pressure. So for you, I'll take down the flag and free you of any other ribbing as a result of that.
Excellent.
So wanted to say again, just thank you so much, Jonathan, for joining me. Cheers to joining in SEG Coffee. We really appreciate it. And look forward to working together again in the future.
Absolutely. Yeah. Thanks for having me, Austin.